Hi, welcome to this AQA A-Level Business Revision video. Today we're looking at 3.5.2 Analysing Financial Performance with a focus on how to analyse profitability. As a reminder, my teaching here is not affiliated with my consultation and teaching roles in any and all academies and schools throughout the country. My name is Mr. Giles. Let's get down to business. So hopefully you've arrived here after watching my 3.5.1 video looking at how to calculate gross profit, operating profit and profit for the year. If you haven't, the link will be in the description down below. Please go back and watch that. It's important you understand those basic concepts. We're going to start over here having a look at our three profit margins that we're going to learn to calculate. Now, if you're in year 13, you will know that there are 10 financial formulas that you need to know. This is 3 of them. These are the 3 most obvious, prevalent, and probably the most useful that you'll know. However, you still need to master the other 7. So we have 3 margins here: gross profit, operating profit, and profit for the year margin. Let's start at the very top. The gross profit margin, simply stated, would be your gross profit divided by your revenue and times by 100. You'll arrive at hopefully a percentage, and it would probably be advisable to go to 2 decimal places. But if you're being asked to calculate this, please check what the question's looking for. The gross profit margin, as I've put over here in pink, is a really good reflection of the economies of scale of a business. Before we get too much into that, a little focus on why we bother doing this in the first place. What's wrong with just the raw numbers? Well, oftentimes, especially in paper 2 and paper 3, they like to give you the gross profit figures for the business and the revenue figures. And then they like to give you either legacy data, i.e. previous years, or they like to give you industry averages. Now, here's the problem. You cannot compare one business to another. Even if you try to compare Asda to Tesco, you wouldn't be comparing a fair amount of numbers because Tesco's revenue is twice that of Asda's. So that is not a fair comparison. Does Tesco make more profit than Asda? Yes, as you would assume so, because they have twice as many stores and twice as many customers. So by dividing it by the revenue and timesing it by 100, we get a percentage which is a like-for-like comparison. If Asda's gross profit margin is 30% and Tesco's gross profit margin is 32%, then we can comfortably say that Tesco is much more efficient with its economies of scale than Asda. But let's imagine it was the other way around. We know that Tesco physically make more profit just in terms of raw numbers. But imagine that Asda's gross profit margin was 40%, but Tesco's was only 30%. You could then argue that Asda was a far more successful business in terms of raw materials and economies of scale. Now, do Tesco make more money? Yes, the bigger number always wins. But when we're actually getting into the nuts and bolts, the nitty gritty of success or performance, this tells a very different story. So yeah, Tesco may well make more physical money, but it would appear that Asda have strategies and tactics that are far more efficient when it comes to economies of scale. That's why we do the comparison. Let's explain this economies of scale concept. So we'll keep Asda and Tesco. Let's imagine for a second that for every pound of revenue that Asda makes, it spends 60 pence on raw materials, 60 pence on the actual stock on the shelf. So for every pound of revenue it generates, it spends 60 pence. That means its gross profit margin would be 40%. Okay, 60 over 100 gives me 40 over 100 gives me 40. Okay, so its gross profit margin is 40%. Now, if we compare that year on year on year, and every year Asda's revenues go up, great, but every year its gross profit gets better and its gross profit margin gets better, we know that as it increases its revenue by either prices or output, it is also getting a better price for its raw materials. And you would expect to see that as a business grows and has more customers, it buys more raw materials. So you would expect them to be getting a better price for those raw materials. And we can link that to Porter's 5 forces, because as a business grows, it has more power over its suppliers. Ergo, it can wrangle or negotiate a better price for its raw materials. It will get those economies of scale. So that's what the gross profit margin essentially tells us. How good are our economies of scale? Are they growing over time? Are they better than our other competitors? Up next, we have the operating profit margin. Again, simply stated, it is the raw operating profit figure divided by the raw revenue figure times by 100. We get another percentage calculation. This one is a really good driver of understanding efficiency of expenses. So these two work in tandem, they work together. And again, context is key here, so try and keep along with me here. We're going to carry on using Tesco and Asda. We would assume that Tesco or Asda's biggest expense has got to be raw materials because they have shelves and shelves full of products. So let's get some realistic numbers here. Let's imagine Asda's gross profit margin is only actually 20%. That's probably close to what it is. So for every £1 of revenue they generate, they spend 80 pence on buying those products. So they get to keep 20 pence, but they haven't paid any expenses yet. Then they pay their rent, their wages, their salaries, and insurances, and all those other expenses. And then their operating profit margin comes out at a meager 5%. So 80% of their revenue was spent on raw materials, 15% of their revenue was spent on other expenses, 5% is taken through to the final calculation, but we would say that 5% is their official profit margin. That's very accurate for Asda, and in the context of a supermarket, probably makes a lot of sense. If Asda's wages or rent was a bigger expense than its raw materials, I'd be asking some serious questions there. Let's turn that on its head though. Let's find a service-based company. I'll go back to my hairdresser from my previous video. Imagine my hairdresser's gross profit margin was 20%. So they're spending 80% of their revenue on gel, shampoo, conditioner, all the stuff they use in a hairdresser's. But they're only spending 15% of their revenue on the wages for the actual hairdressers. That would ring alarm bells to me. Shouldn't the biggest expense for a hairdresser or any service be the people providing that service? So actually, in the context of a hairdresser, you would expect that the gross profit margin would be high at like 90%, because they don't really have raw materials. But then you would expect it to dip when it gets to the operating profit margin, because you would expect that wages and salaries are really, really high for that business. So you would expect that the operating profit margin would then dip down to say 10%. So 10% of it is going to the raw materials, but then 80% of their revenue is going to wages and salaries. That, in that context, makes a lot of sense to me. That seems sensible. And that's why we have these, because when we get to make wonderful comparisons like that. And if we think about paper 2 and paper 3, we're going to be given great context, a great deal of context. And if we start calculating these numbers, yes, we're going to get some marks, especially if there is a calculation question. But remember, there's not always a calculation question, but there is often always numbers. So we do these wonderful calculations, but now we can start making judgments about them. Is it right that this business has a high or low gross profit margin? Is that correct for the context? Does it have a lot of raw materials? Or is it right that its operating profit margin is so high or low? Is it right that there's a huge disparity between the two? Okay, so let's say again, your gross profit margin is say 90% and then your operating profit margin is 5%. Does that make sense? Is that correct in the context of that business? That's far more important than the actual calculation itself. Then, lastly, we get into our profit for the year margin. As I said in the previous videos, this doesn't really come up a great deal in AQA A-Level Business, but we still need to know it. So we simply take our profit for the year and we divide it by revenue times by 100 and we get a percentage. Now, what this tells us is the external environment's impact, because remember, profit for the year is tax and interest. So those two things are heavily impacted by the government. All right, so tax is fiscal policy, interest is monetary policy. So if the government are messing around with those two things, we might see an impact here. So if you get economics-based questions in the exam and it starts asking about fiscal or monetary policy, you know that fiscal policy is government spending and you know that monetary policy is interest rates. So if those two start being shifted or changed, that's where you can expect to see the impact there. and that will just give you a bit more accuracy in your answers. So, secret sauce for this one, always look for either the legacy data, which they have done in the past. They've given you 5 years worth of operating and revenue, operating profit and revenue, and then you can work out the change. And if you can work out the change, if you can work out the difference between, say, 1 year and the next year, or 1 year and 5 years later, that will be fantastic context in any answer. So go looking for that. I'm thinking back to a paper 3 they did, I want to say it was 2017, and there was a bar chart of operating profit and revenue for 5 years. And so you could work out the operating profit over 5 years and see the general trend. That's a far more solid answer than just saying the operating profit is blank. And then the other thing, the other secret sauce I would say is to make sure you look for other ways that this might be being impacted. So for example, with the operating profit margin, we're talking about efficiency of expenses and wages and salaries. Does it give you the labour productivity? What's happening to labour productivity? Is it going up? Is it going down? Because if labour productivity is going up, that means our workers are producing more without getting paid more wages. So I should see this number go up, because if they're producing more, I'm selling more, my revenue will go up, but my wages should hopefully stay the same. And then what's their long-term strategy? Are they opening more stores? Because if they are, that means they're going to have these stores that are not quite working at full capacity. So then you've got wages and rent being paid on stores that aren't generating maximum revenue. That will have a negative hit on operating profit margin. And then I would say the last thing is, are they moving online? Are they thinking about doing some sort of e-commerce situation? Because if they are, again, that might have a positive impact on your operating profit margin, because it might be able to bring the amount of rent down. So we can have more sales, less rent costs, which are a generic expense. If you have any questions, please feel free to ask them below, and I will see you in the next one.